Thanks everyone for joining us today. We have an update with Tantalus Systems, who put out their Q1 numbers, I believe it was last week. So we're going to do a bit of a Q&A going over some of the themes that came out in the quarter, as well as just where the business is generally headed. With me, I have Peter Londa, who's CEO of Tantalus. As always, we may not be working off a presentation, but this presentation will contain forward-looking statements. If you'd like to know more of those, you can find them on the company's website. And there will be a Q&A section throughout, and I'm happy to take audience questions, so feel free to input them in the Q&A box at the bottom. With that out of the way, I'd like to introduce Pete Londa. Hi, Pete. How are you doing?
I'm great, Deb. Thanks for having us.
Yeah, you're welcome. You had a great quarter. Maybe we could start with a bit of a discussion about that. I think this is the first quarter that you've seen a return to top line growth in the last few more difficult quarters. Do you want to talk a little bit about that to get started?
Yeah, absolutely, Deb. And just for everyone's benefit, I might bring up a couple bullet points to talk to. We won't flip through slides necessarily, but yeah, we were really pleased with the strong momentum that we had coming into this year based on how things unfolded, particularly with supply chain disruptions last year and pushing revenue into 2022 and in some circumstances even beyond. But we had good visibility and as a result of that visibility at the outset of this year, conveyed our expectations that our top line revenue would grow 20 to 25% through the calendar year. To that end, we got off to a great start in Q1. Revenue grew from $8 million last year, Q1, to $9.3 million this year, representing 16% growth. Bundled in that is 28% growth year over year on the revenue that we generated from software and services. Some of that is tied to our recent acquisition of Congruitive, which is a software and services business that we announced at the end of January. So we get the benefit of a few $100,000 of revenue contribution through February and March as a result. But really strong growth from a software and services perspective. That led to an increase in our gross profit margin from 45% a year ago to 48% in Q1, which is a bit of an anomaly given some of the inflationary pressures on supply chain and components that we purchased to build our devices. But it's directly tied to the software and services contribution and frankly, our team being able to navigate through really challenging times at the macro level. We shared that as a direct result of investments that we are specifically choosing to make in R&D, the acquisition of Congruitive that we announced in Q1 and absorbing their costs and certainly in continuing to invest in sales and marketing, that has had some near-term impact on our ability to get back to quarterly positive EBITDA. Going public, we had, and through the first 6 months of being a publicly traded company, we delivered 19 consecutive quarters of positive adjusted EBITDA. We're continuing to absorb the costs of being public. We're also, with the board support and the strength of our balance sheet, making very specific investments that we believe will continue to drive growth for this company moving forward. So it has some near-term impact, but nothing from our perspective that really is disruptive to this business. The cash on the balance sheet remains very strong at $12 million US. That's net of using $3.5 million of cash in our acquisition of Congruitive, along with the transaction fees that went with it. And a new metric for us that we started to share this quarter is really a sizable amount of recurring revenue that's bundled into our business. And to give you some perspective on that, I'll just flip to another slide. Over the last 5 or 6 years, we've made a conscious effort and continued to invest in the software and services of our company. And we get our devices embedded into the field. Those devices are there for 12 to 15 years at a minimum with utilities, creating an incredibly long and sticky relationship with those utilities. That hardware then enables us to sell software and services based on the data that our devices continue to access every day of every year. And so you're seeing a really nice trend in our business that is approaching $9 million US of annual recurring revenue broken out between software maintenance, technical support agreements, hosting services, and subscriptions to our new analytics tools. So yeah, we were happy and fortunate to be able to provide some positive news in light of what otherwise has been, I think, a tough time for a lot of other small cap tech companies.
You mentioned a few things that I'd like to dive in a little bit more into. So first, can you talk a little bit more about some of the changes you're seeing in terms of supply chain logistics and inflation, and what headwinds you're still seeing and how you intend to overcome them?
Sure. So it's a complex business environment and very fluid. On the supply chain side, relative to the impact that had on us really through Q4 of last year, what we've seen, I think from the hard work of our manufacturing and operations team, is a stabilization of lead times. And so, I just show and tell, Deb, we build some hardware. This is like the guts of your iPhone, and a lot of components on this to provide edge computing under the glass of a meter. That's the face of a meter. We don't build the meter. We build the edge intelligence that gets integrated. And so what we've seen across our microchip semiconductor vendors, we have two, our radios, our RAM and flash memory components, our super caps and poly caps for power supply. We've seen a normalization of lead times. They're longer than what we've witnessed historically, but they're stable, meaning we haven't seen decommits. We haven't seen extensions of supply chain lead times for the key components. And so, for the long lead time parts, we're 6 months into this episode, really, if not longer, on supply chain constraints that started to surface in the second half of last year. And so our manufacturing has been able to catch up and absorb those lead times. We're ordering to forecast at this point. We're building buffer stock to navigate any near-term disruptions that might unfold outside of our control. But that's how we're navigating through it. And so as long as we continue to see that stabilization, it gives us the ability to predict. A little bit beyond Tantalus, we do have meter partners. Those are, the Itrons and Landis & Gyrs of the world that are manufacturing meters. We continue to see extended lead times from the meter manufacturing partners. And depending on how they're navigating through their supply chain constraints, we could see some disruptions quarter to quarter. But at this point, we have enough visibility on our side, as well as our meter manufacturing partners, to still reaffirm the revenue growth that we expect in this calendar year and beyond. On inflation, where we're seeing that is in a couple of areas. We are seeing some pricing pressure through our manufacturing partner and our supply chain. It's translated into some compression of the gross margin on our hardware, but we've been able to balance that with the incremental margin contribution from our software and services. And so hence gross margin increasing in Q1. We've initiated a price increase that went into effect April 15th. We did not get pushback or concerns from utilities, which leads us to believe that we still have the ability to implement incremental pricing increases to the extent we need to, and to the extent that we just continue to absorb some pricing pressure. We did see at the beginning of this year some pricing pressure or inflationary pressures, I should say, on compensation. We saw some larger tech companies that were, I think, obscenely offering salary and compensation to try to staff their organizations. In the last 6 to 8 weeks, we've seen that subside drastically. I think as probably portfolio values have come down, and as the larger tech companies have had to start to normalize some of their activity, we're starting to see a little bit more stabilization on compensation expectations, especially with new hires. So hopefully that trend continues for us, but we'll navigate through it. And fortunately, the balance sheet's strong enough to avoid any really long-term disruptions to this business.
Okay. And you mentioned your newest KPIs as being recurring revenue, analyzed recurring revenue, and you went through the different segments that go into that. Can you talk a little bit about how you're growing that and sort of what the margin profile is of the different divisions that go into that, and maybe like a pathway, where do you see that stabilizing? I think it's about 36% of your business currently.
Yeah, so a couple things to unpack there. The recurring revenue is it's enabled from the devices that we put into the field with utilities. You can think of us a lot like Apple, but instead of on the consumer side, on the utility side, right? An industrial type customer base. We're selling them computing capabilities and networking capabilities to access connectivity to devices. meters, load control switches, distribution automation equipment, substation equipment. From those devices, we access data, consumption of electricity, power quality, voltage, current, harmonics, phase, and a whole bunch of parameters that the utilities pay close attention to every day. As we accumulate that data, and today we are accumulating over 30 billion data points a year across our user community, we're able to monetize that data through investments in our software applications and our analytics capabilities. The software tools and the analytics capabilities then give rise to additional professional services that we offer to utilities. So we're really a hardware-enabled software and services business with now 36% of our revenue coming from software and services, and longevity there to build recurring revenue based on the data that we're capturing over decades with utilities, and an opportunity to continue to sell them that software and services. Incrementally, most utilities have historically wanted to own the IT infrastructure behind their firewall. It's critical to the operations. The data that we're delivering to them is critical to their day-to-day operations. Over the last year, we've started to see that migrate, where utilities are looking to us to offer hosted services, meaning servers that we're installing at our, at an IT center that we're contracted with, and then really maintaining the IT infrastructure with VPN connection and obviously appropriate security and firewall protection for the utility to access that data. I think that hosted services revenue that's starting to build for us, order of magnitude, about $500,000 of revenue a year right now. As that continues to build, I think it also lays the groundwork for broader SaaS offerings and cloud-based services, which is what we've started to launch with our new analytics tool called the Tantalus Grid Reliability Analytics Tool, which is really at the forefront of power quality analytics for utilities. It's a market-leading solution, and the amount of attention it's getting across our user community is robust. We are selling that as our first SaaS offering. We have 6 utilities fully subscribed now under a SaaS license. We have 25 utilities actively evaluating that tool in the first 6 months of bringing it to the market. So those are the contributions and how we're driving the recurring revenue. On a blended basis, our recurring revenue is coming in at about a 78 to 80% gross margin. So as we continue to scale that over the years, we'll ultimately be able to drive real gross margin contribution to drive operating leverage across the income statement.
Got it. So hardware will always be a component. Hardware sales will always be a component of the business. Where do you think you can get to on the recurring revenue side?
Yeah, so I don't think there's a limit for us on the recurring revenue side, but for the ability that we have to make investments in R&D and leveraging the analytics engine that we are continuing to invest behind. We have our first analytics tool we started to roll out really at the beginning of Q4 of last year. That's, with 6 utilities now subscribed and 25 evaluating. We're already working on a second and a third analytics tool, the second of which is going to go into prototype with a few utilities this summer, with the idea that we're able to commercialize that hopefully in the early 2023 timeframe. So I think that the devices, it's the Cormark analyst asked us that at their recent investment conference of would we ever get out of the hardware business? And definitively, the answer to that question is no. The hardware is what creates the sticky relationship, these multi-decade relationships with utilities, and it's what enables our access to data. As we continue to mature as an organization and invest in R&D, we're really just starting to scratch the surface of what the recurring revenue and the software and services can achieve. As we see scale from the acquisition that we've made, as we start to think about more strategic initiatives, organic and inorganic, internally, our goal is to flip the script where more than 50% of our revenue comes from software and services, with the idea we can scale that over the next 2 to 3 years, maybe 3 to 4 years. But it's we're not far away from really being able to increase that recurring revenue and increase the software and services contribution, where it's more than 50% of our overall revenue profile.
One of the other notable things in the quarter was customer adds. You added 5 new utilities plus over 40 utilities with the Congruitive acquisition. Can you talk a little bit more about Congruitive and why it's an important acquisition for Tantalus beyond just customer adds?
To just quickly touch on the customer adds, Deb, thanks for that question. I joined the business in 2014, just a little bit of history here. At the time, Tantalus was supporting just over 50 utilities through the first 25 years of the company's history, maybe 24 to be more precise. Not just because of me, but I think that the changes in our business and some of the strategic initiatives that we set out in the leadership change of the company, we're now at over 250 utilities. So it's a 5-fold increase in our user community over an 7-8 year time frame, which is really astronomical. When you think about a small organization scaling, the user community is something we focus on heavily because once a utility locks into us, they're with us for at least 15 years. And in many circumstances, we're now entering a 3rd decade of a relationship to continue to drive revenue from those accounts. So it helps us with predictability. As it relates to Congruitive, a couple of key takeaways on the user community. Historically, Tantalus has focused on public power and electric cooperative utilities. The utilities that just have fewer meters or smaller businesses. It's about a third of the power industry and the electric utility industry here in the United States, about the same equivalent in Canada, maybe a little less. Congruitive today is supporting some of the largest investor-owned utilities in the US, Pacific Gas and Electric in San Francisco, Southern Cal Edison in California, PPL in Pennsylvania. They have a rich history of supporting those utilities, and they're really entrenched with those organizations. So by making the acquisition, it allows us to enter the investor-owned utility segment, much larger utilities with a lot of credibility. And while the focus initially is going to be how do we scale Congruitive's technology to as many of those investor-owned utilities as quickly as possible, I think it lays the groundwork for us to potentially position the broader capabilities of what Tantalus does today on the analytics side, on the networking side, on the software side, potentially sell into that market over time. That'll take some time for us to gain credibility in that market segment. But we see revenue synergy potentially through the IOUs that Congruitive brings to this party. And the flip side to that is taking their technology, which has not historically been sold into the munis and co-ops, and being able to, as we integrate the technical capabilities onto our network and onto our devices, the real revenue synergy will be bringing their capabilities through our sales channel and this growing user community of public power and electric co-op utilities. So I think there's revenue synergy on both sides. The near term is probably more in alignment of taking their technology into our channel as opposed to taking our core into their channel. But we're really excited about what it means in terms of the customer opportunity and really increasing the total addressable market opportunity we can pursue.
Okay, that makes sense. Are you able to wrap some numbers around that? For example, looking at one of your existing customers, if you were to layer in the Congruitive offering, like what's sort of the potential revenue on a per client basis from that? And maybe you could do it the other side too. If you took a Congruitive client and layered in your other offering, maybe just to give the market an idea of what kind of revenue could be generated out of the cross-selling opportunity.
Yeah, so bringing in their capabilities into our customer base within a bell curve and very high level numbers. Now, it's upfront software that's in the order of magnitude of hundreds of thousands of dollars of a software license that ties initially a head end that's deployed at the utility level, and then an endpoint license that ties to every device that connects to the Congruitive capabilities. And so at a high level, you can think of Congruitive as a Google Translate tool for electric vehicle chargers, rooftop solar inverters, battery wall inverters, and microgrid controllers. And so everything that's unfolding in the distributed energy resource space and the electric vehicle adoption, all of which are really disruptive to the continuity and the infrastructure in the distribution grid. we can dive deeper into that if you'd like. But so the goal is get the sort of Google Translate, simplifying it, but get the gateway software, the head end, deployed at the utility. And then for every incremental EV charger, solar inverter, battery wall, or microgrid control that emerges, is get an incremental software license that would lead us to a recurring revenue model of a per endpoint per year type fee for the utility to access data across our network to those devices behind the meter. And then beyond the access to is the command and control. How does the utility make decisions based on storms or changes to the output of a rooftop solar installation? Or what does the utility need to do in system planning when multiple electric vehicle charging stations show up at a home or at a Whole Foods or at a Walmart within their footprint? And so it's that granularity that is where initially we'll see revenue materialize. So it's order of magnitude of a couple $100,000 account by account, and then a recurring revenue stream that will build from that. Incremental as we access data from, example, EV charging infrastructure, solar panels, battery walls, microgrids, that'll lead to analytics as well, right? What can we learn from the data and the consumption EV or the discharge solar EVs, and how that impacts the grid's planning on a day-to-day basis? How much demand do they need? How much load do they need to deliver? How much load can they receive from some of those devices that are throwing power back into the grid for the first time? So I think that's incremental. Sorry to be long-winded on that one. The inverse, if we were to take a Tantalus solution, network, the edge computing under the glass of a meter, distribution automation equipment, load control, you're talking at a typical investor-owned utility with 1 million endpoints, we're talking in excess of $100 million of opportunity for us, if not more, to bring our solutions into that type of market segment. There are a few scenarios where we've seen companies do that, and I think we're going to lay the groundwork over the next several years to try to position ourselves for it. It's not a near-term type event. It'll take time, but that's order of magnitude of where we could see a wholesale change in this business very quickly.
Interesting. So in terms of like connected endpoints that you would have access to through your current customer base, like how many would that be, do you think?
So we've got 2.8 million connected endpoints already in the field that are delivering 30 billion data points for power quality and electricity consumption today. Within the user community, our existing customer base, there are another 1.5 million endpoints that we have not yet deployed. That translates into about $150 million of opportunity still within the existing customer base, just on the hardware side of our business, not including the software side. Give you some points of comparison with the likes of an Itron, which some investors like to compare us to from an investing perspective, which we can talk about. I don't agree with that comparison, but Itron, hundreds of millions of endpoints deployed, but of those meters that they've deployed, they're talking in their most recent quarterly report, 4 to 4.5 million intelligent endpoints deployed globally. So when you look at it on a direct comparative basis, we're at 2.8 million endpoints today. Itron's just over 4 in terms of really intelligent devices, just as a reference point. So, I think that puts us really at the forefront of market leadership in this really, 2.0 wave of gathering data from meters and driving business decisions and operational decisions at the utility.
Okay, great. I think that you've covered all the cross-selling opportunities available. Can you talk a bit about how you're targeting new customers and what sort of is an ideal customer for Tantalus at this stage?
Yeah, so I'll give you not only on the utility side, but with Congruitive, an expansion of the verticals we can pursue. That still in our wheelhouse, and really the core purposes of our business is to help public power and electric cooperative utilities really digitize the distribution grid. And so the ideal customer there is regardless of size, a utility that is really trying to proactively and progressively change the nature of their business. From our view, utilities have always been viewed internally by themselves, externally by investors as power companies, either generating power and or distributing power. And then we just pay our bills. The future of a utility is not just delivering power or water for that matter. It's becoming a data company. And so we are seeing the urgency from utilities to engage on the IT side and think through what they can do with data to be much more sustainable and much more efficient, particularly in a world that's demanding utilities to reduce their carbon footprint. So the ideal customer for us is really a forward-thinking management team that is looking to go way beyond just the traditional meter reading capabilities of smart grid, which is the way most people have thought about this for the last 20 years. How do you automate billing? How do you turn on and turn off customers? Right? This is significantly greater based on power quality at a specific location within the distribution grid. What does that mean to prevent a fire? What does it mean to protect an asset which now has extended supply chain constraints for the utility to manage around? So it's really utilities that see the digitization of their grid as a wave to become data-driven, evidence-based companies. That's the ideal customer. Incremental to the utility industry that we have historically focused on, meaning direct sale to the utility, Congruitive actually opens up a great opportunity for us to take technology and sell it into OEMs. So example, Cisco, existing partner of Congruitive, which we'll look forward to sharing some more information in the coming months and quarters. We have a path to embed our capabilities from Congruitive onto every industrial router that a Cisco deploys globally. That allows that industrial router to bring data into a substation or bring data to the utility as Cisco continues to focus on opportunities like that. So, that's a great path for us to diversify the revenue stream through OEMs that are selling equipment into utilities or into the C&I space. And a second example of that is a press release we announced just a few weeks ago. It's a new partnership with a microgrid focused company called Energy Toolbase that's based in California. Energy Toolbase is deploying microgrids that include solar and batteries to large commercial and industrial businesses that in many circumstances in California, because of all of the horrendous wildfires, utilities are now mandated going into the summer of potentially rolling blackouts when there is a heightened risk of wildfires. That means commercial and industrial operations lose access to power from Pacific Gas and Electric, as an example. So how are they responding to that? They're investing in solar and batteries to island themselves off of the grid. We're embedding Congruitive's capabilities into Energy Toolbase's microgrid solution so that the data from that microgrid can seamlessly and most importantly, securely be integrated into the utilities programs. So signal utility shutting down areas, C&I customer islands with Energy Toolbase's technology, activate CIQ's technology along the whole gambit there. And order of magnitude, the expected growth of the microgrid industry is projected to be an 18, if not $20 billion market opportunity in the next 3 years. So all of a sudden, we don't have to sell microgrids to utilities or C&I. We have a partner in ETB that's already actively doing it. So we can leverage their channel to gain scale on the technology that we're now investing behind. So it's a great way for us to diversify our customer base and drive incremental revenue growth for years to come.
Can you explain the Cisco partnership a little bit more, like what technology you actually provide and how many of those, I forget what you called them, but the hubs that they would have internationally?
I'll share what I can share. We'll be looking forward to providing some exciting news, I think, in the not too distant future. And I'm heading to Dallas next week for our largest industry trade show that's going to unfold for the first time in person in the last 2 years. And we'll have a heavy presence there with Cisco in particular. Cisco is in the business on the networking side of trying to help utilities connect critical infrastructure inside substations or in the field. And they're building routers to help do that across a variety of different communications networks. The partnership is embedding the CIQ technology, which is what we've acquired from Congruitive, onto those industrial routers. The reason why Cisco is doing it is because we are the leader today. We are the first company to be able to build a gateway, software gateway that could sit on Cisco's routers that comply with an IEEE standard called 2030.5. That standard is being adopted quickly across the utility industry for interoperability, meaning data from different devices that can be integrated into mission critical systems. But most importantly, it complies with an emerging security standard that utilities have to comply with in today's world of cyber threats, especially the horrific events that are unfolding with Russia and Ukraine, and how unfortunately Russia is trying to continue to hack into critical infrastructure here in the US. So the IEEE 2030.5 is geared in many ways to provide interoperability and security through a utility's firewall. It's now mandated in California under what's called Rule 21. Every utility in California has to ultimately roll out a 2030.5 standard to bring data from an increasing number of distribution automation equipment and distributed energy resources. And so we're that leader today with this acquisition. What Cisco's looking to do is continue to take our technology, embed it onto their routers. That triggers a license for us that will be recurring in nature. And they're looking to roll that out on a global basis. Order of magnitude, if I understand it, it's a few 100,000 devices that Cisco has built and deployed over the last few years here in the United States. I think their view is that gets magnified and multiplied globally, and the Congruitive technology will play globally. So as Cisco's successful in rolling out their latest and greatest industrial router for the utility industry, we can hopefully piggyback on their success by being an incremental software feature on that router that gets activated as soon as they sell the router itself. So I think there's real scale there for us. It'll take some time for that to unfold, but a great way for us to drive software revenue and recurring revenue on ongoing annual licenses and ongoing annual maintenance support.
Okay, that's really interesting. Getting back to specifics in the quarter, you guided to 20 to 25% top line growth. How do you expect to achieve this? Is this a sustainable growth level for the company? Maybe you can talk a little bit about that.
Yeah, so we've been a little hesitant to do multi-year guidance to date, just as a relatively new issuer, and really just trying to get ourselves acclimated to reporting on a quarterly basis. For this calendar year, what anchors the 20 to 25% growth year over year is the existing backlog, the backlog that we had going into the year, and frankly, the success that we've had in Q1 on closing orders. And you'll see within our earnings release, we set a record in our company's history of driving $16 million USD in orders out of our pipeline. That further add to backlog, not only for this year, but then aggregate backlog moving forward into future periods. So it's a combination of the backlog that we have already in hand, the visibility we have into orders from our existing customer base that really operate a little bit more once they're fully deployed on a book and ship type business that's repeatable. We have very good visibility into what the purchase plans are for our existing customers to continue to roll out devices. That's incremental to our backlog today. And then we've got, the benefit of the full $9 million of recurring revenue that gets peanut buttered across the full calendar year as we tick that off each month. So it's a combination of backlog, visibility with existing customers, and that recurring revenue that are giving us the confidence to the revenue growth trajectories. And we're susceptible to the meter manufacturing supply chain constraints that those third-party groups are navigating through. But at least based on what they've conveyed to us and our expected timing of when devices get shipped and software licenses get activated, we still are very confident in that revenue trajectory this year.
Okay, and you don't currently disclose your backlog on a quarterly basis?
Not yet. I think we're planning to do that as an incremental metric as we continue to enhance our quarterly reporting. We're starting to approach a record high in our backlog, a portion of which will materialize for the balance of this quarter, the balance of this year, and then a portion of which is for future periods, 2023 and beyond. We're very focused on converting orders out of the backlog, out of our pipeline, and I think we'll be able to share some pretty favorable news through Q2 on continued success of driving orders, which really ties to the urgency that we're seeing across the utility industry to really truly digitize their network for the immediate and long-term horizons.
Okay, I think we've beat backlog to death. So your gross profit margin expanded from 48% to 48% from 45% a year ago. What's driving this expansion, and is it sustainable? Do you have a long-term target for gross profitability?
Yeah, longer term, our goal is to get over 50%. It's hard for me to precisely predict when that will flip to the next 10th percentile of crossing over the 50% threshold, but we're getting close. In the near term, we could see a little choppiness just based on the inflationary pressures and revenue mix in a quarter, software and services versus hardware, especially if our meter partners don't ship certain meters in one quarter. That means a lower contribution from hardware, but it means a larger contribution next quarter when things catch up. So I think we'll see some buffers, but in all circumstances, we continue to see at a minimum the mid 40th to upper 40th percentile continuing to trend this year, which is very strong in the broader smart grid market segment from our perspective, and an outlier, frankly, across other smart grid companies and sort of the broader IoT space. And so that gives us comfort that we're doing the right things internally. We're managing through what we can control and managing our partners on the supply chain side as aggressively as possible. Like I said, we've got, I think, the ability to raise prices if we need to. Moving forward, there's a lot of value in what we do. And I think as a result, some inelasticity, meaning we can increase prices and there's not a lot of places utilities can go. With that said, we're focused on multi-decade relationships, not near-term quarterly gross margin per se. So we'll try to balance the near-term requirements and the expectations of investors relative to trying to make sure we maintain those multi-year, multi-decade relationships with utilities that take a much longer perspective.
Sure, makes sense. On the flip side, I'm sure that they want to make sure that you're in business as well, right?
Yeah, absolutely. It's a symbiotic relationship there. And so, so anecdotally, we got a number of utilities that reached out and said they fully understand, and they thanked us for not being more aggressive, and that if we need to continue to increase prices, they understand. If we can do that sequentially and over a period of time, it allows them to avoid disruption in their budgeting process as well. So that's the mentality we're taking, and I think we do have the ability, if we need to continue to push prices up a little bit to manage through this near-term issue.
Yeah. Well, I think everyone's sharing your pain a bit, Pete. It's been a brutal environment out there for sure. So Congruitive is your first acquisition as a public company. Can you update us on what your current acquisition strategy is going forward?
Yeah. So there are a couple of areas of really high area of focus for us, almost all of which are on the software and services side, right? We do a good job of accessing data. How do we monetize that data for our shareholders? How do we turn that data into value for utilities? There are a couple of areas of focus that tie to enhancing and accelerating analytics based on the data that we already have access to. There are a couple of smaller organizations that we are either already starting to assess how their analytics tool can fit into our engine and leverage our data. So we're looking at a few prototyping and proof of concepts at existing utilities within our user community that will, I think, give us the confidence that it's the right tool that can integrate on our system and be value add to utilities for purchasing and driving scale. We're looking at a few expansions on what we do with the meter data itself to help inside the utility, whether that's prepay applications, meter data management capabilities, or some other areas like that. We're also looking at how we invest behind Congruitive's capabilities around helping utilities really prepare for EV chargers, rooftop solar, battery walls and microgrids, broadly defined distributed energy resource management capabilities for the utility. That's where we're focused. We are still remaining engaged with a number of the targets that we had going public, and certainly that we were starting to pursue through the second half of last year, we prioritized congruitive, and that's where we focused our time and attention. We're still a small team, so there's only so many deals we can do at once. The near term and downward pressure on our stock price is not necessarily giving us pause to do the right thing long term, but obviously, doing a deal in today's environment becomes a little bit more expensive and a little bit more dilutive to our existing shareholders. So we're going to try to balance what's unfolding near term versus what's the right thing for the company long term. But I think we're still staying very active, and to the extent we see something that makes a lot of sense and that we can digest and it's not too painful relative to where share price is today, we'll execute.
Makes sense.
The balance sheet definitely gives us the flexibility to do that today.
Yeah, for sure. Maybe you can give us a little bit of an overview of where the balance sheet's at.
So we have $12 million USD of cash today available. That's net of $3.5 million of cash that we used as part of the consideration to congruitive, plus the fees that we incurred, legal, investment banking, accounting, and ultimately some of our own diligence. So, and looking at their technology with the support of some audits that we ran. So, I think the balance sheet, at the end of 2021, sort of December 31st, was just a little north of 14 million. We used $3.5 million plus for the congruitive deal, and we ended the quarter at 12 million. So if you think about it on a net basis from an operations perspective, we actually generated positive cash in Q1. We did incur some additional debt as part of the deal consideration with congruitive. So our current debt stands at $11 million. We entered this year with $8 million with Comerica. They were supportive of absorbing $3.3 million of debt that was on congruitive's balance sheet under our facility with them. So our debt has gone up a little bit, but our total assets have increased to $40 million at the end of Q1. We still maintain very robust adjusted working capital that's positive to the tune of $9 million. So we got line of sight to more money coming in through core operations, and shareholders' equity continues to be on the positive side as a small company. So balance sheet's pretty strong.
That's great. I think that you've talked a lot about the M&A initiatives that you're going to be implementing in terms of growth strategy. I don't know if there's any that you left out that you wanted to talk about, but I was also curious about the decision to invest in R&D at sort of, the near-term impact of profitability, and maybe you can talk about that strategy.
Yeah, thanks for the question. So we weigh a lot of variables in making the decisions here, and we try to be as prudent as we can and manage short-term versus long-term, especially now as a newly listed public company. The R&D initiatives are threefold. And really, if you look at our earnings and OpEx, the operating expenses of the business, the best comparative is where did we end last year, Q4 versus this year, because Q1 of last year, we still weren't publicly traded. So it's not a great apples to apples comparison. OpEx from Q4 last year to Q1 this year increased by about $500,000. I'm rounding. The incremental investment is the 2 months of costs that we've absorbed from congruitive. We've picked up 9 new employees, almost all of which are engineering or product marketing related. And then organically, we are investing heavily right now in what we shared last year around our TrueSense Fiber Gateway, which is a new device that we are bringing to market. It is absolutely a market-leading solution for any utility that's already deployed or in the process of accessing stimulus funding to bring broadband services to their community. It will enable utilities to not only connect a meter to a fiber network, you're talking real-time, almost streaming data, to be that much more granular in how to self-fuel their grid, but it'll give utilities for the first time real access behind the meter. We're embedding Wi-Fi and home plug connectivity capability to reach into the home for utility grade Wi-Fi, not for social media and consumer use, but to connect to those EV charging stations, to connect to the inverters for rooftop solar panels or smart appliances. And it'll be that incremental data flowing through the network that we're helping utility deploy that will lead to additional software and services and analytics for us longer term. So we're on course to bring prototypes into the field this summer. We're looking to try to get to UL certification for that device by the end of this year, such that we can get into commercial scale and manufacturing in 2023. So, it's a $1 million plus investment that we're making today to bring a new product into the market for next year. In our relative to pipeline opportunity today, not necessarily saying that we'll get it all. Order of magnitude, we've got line of sight to over $100 million of opportunity with electric cooperative utilities and public power utilities that either are already have deployed fiber and are looking for their next generation solution to leverage that investment, or utilities that are have received stimulus funding to deploy fiber and broadband capabilities and use our tool to do that effectively. So, it's near term, order of magnitude, a big investment for us, $1 million plus. Long term puts us in a position to pursue what ultimately through the life of that product would be hundreds of $millions of revenue opportunity. And our goal is to try to get as much of that as quickly as possible before our competition catches up.
That seems like that would be a good return on investment, Pete.
And so if I don't mean to be snide about it, but as the CEO of the company, if we can make that type of investment to put our business in that type of position to scale, even if it sacrifices near-term EBITDA relative to the balance sheet, that's an investment that we're going to make. And we think it's the right thing to do long-term for shareholders and our company. So that's what we're doing. And that's really, that and congruitive are really where we're spending the incremental dollars. And that's why, the OpEx is a little bit high relative to the revenue profile today. And it's not as if it's a significant EBITDA burn, it's manageable. If things really get tight, we can dial that back very quickly and get back to an EBITDA neutral number within reason. And so I think as long as we have that granularity and that control, it's a measured investment that we're making that I think is prudent for people long term, certainly our shareholders long term.
Well, you've got to run your business, right? I think that managing your business rather than managing the market or the share price is always a better strategy for small companies as they execute on growth strategies. I had one last question. I haven't seen any audience questions, but if there are any, feel free to put them in the Q&A box. The last thing I wanted to talk to you about, Pete, and I don't want to get into a big, long debate about valuation because, I don't know, multiples are good sort of to get a general market sense, but I'm not going to argue, that multiples are the be-all and end-all of investing. One of my mentors used to tell me that multiples are for teenagers. I don't know if I fully agree with that, but you mentioned Itron earlier on in the discussion, and it's a company you get compared to quite frequently. And actually, when I looked this morning, you're trading pretty much in line with Itron on an EV to sales basis. So maybe you can explain some of the key differences and similarities with Itron, just so that we get a better understanding of how similar or dissimilar the two companies are.
Yeah, and I'll allow the 5 research analysts that are covering us today to provide education on valuation and consensus. I understand that when investors have historically looked at smart grid, they've looked at smart metering. And that then lends itself to the largest meter manufacturers in the world that are certainly publicly traded in North America, Itron being one, Landis+Gyr being traded in Switzerland, a little different because it's a European exchange, but arguably, if not number one, then number 2 in terms of global meter manufacturing. So we partner with both companies. We sometimes compete with both companies because they have their own capabilities as well. But when you look at Itron, I see clear distinctions, and I'll give you a few. If you look at their most recent quarter and really where they've trended for an extended period of time, their gross profit margin is in the mid to upper 20th percentile, 25, 26, 27, 28%. Over 90% of their revenue comes from the sale of their meters and hardware. If you look further into their earnings, their senior leadership is highlighting what they refer to as their outcomes business, where they're trying to invest. Their outcomes business is what's applicable to us. That's the networking, the data, and that come from intelligent connected devices, and then the software and analytics tools that they're quickly trying to develop too. So part one is just the revenue mix, right? Their single digit contributions from the outcomes, what they refer to, maybe 10%. We're 36% of revenue contribution. If you look through the income statement, their gross margins mid-ish 20 range. Ours are mid to upper 40th percentile, so almost double. Now, that's a clear distinction in the business and the concentration and the type of hardware that we build versus the type of hardware that they build. And I'm not discounting the importance of the meter, right? A lot of what we do depends on that strong relationship with Itron, and they're an excellent partner to us. So I'm not trying to be negative at all in their capacity, but there's a clear distinction just in the income statement alone. Contributions of revenue and how that impacts gross margin. You know, when you scrub a little further, we're at 2.8 million connected endpoints. They're just north of 4 million, from what I understand from their most recent reports, at least from the information we can glean from what's publicly available. So I think a comparison on an EV multiples or an EV to revenue multiple is an unfair way to look at our business, especially if you just look at 36% of revenue from software and services and growing for us, 48% gross margin and growing for us versus the heavy concentration of meter manufacturing. And we are not a meter manufacturer. So that's the distinction, in my opinion. I view us, and easy for me to say, I think investors should look at us more like an Apple, not at that scale, and we're not consumer facing. But what are we doing? We're putting effectively this iPhone into the hands of a utility in the field. Our iPhone looks like this. We're accessing data from the device, which is exactly what Apple's doing. And that's leading to services and software capabilities, which is exactly what we do. So I think we're much more of a network and IoT-based type company than we are a traditional meter manufacturing type company. But I understand the similarities, and certainly they're a partner and they're competitors, so easy to plug that gap and just say it's just like Itron, but we're really not. Sorry, that was long-winded. I'm passionate about that one, so sorry for going a little overboard.
No, I think it's good. I think you do get lumped in with Itron, and it's good to kind of hear what the differences are in the business model. For anyone that's interested, if you want to look at IoT companies, one of the analysts had a comps table, and I think the average comp was about 2.3 times. And if you're looking at SaaS, it's probably about 3.5 times currently, but I'll let investors build their own comps table or find their own analyst reports, but just for context. But yeah, no, thanks, Pete. I don't have any further questions. I don't know if there's anything else you wanted to comment on the quarter or the business currently.
Deb, I appreciate the allocation of your time and the questions. Always more than happy to facilitate or take questions from investors. You know, we're very much focused on trying to build awareness as a newly listed company, and we'll continue to down that path through Adelaide and through the other avenues that we've pursued. And we're really pleased with the start of this year, despite a very fluid environment. And I get the benefit of answering your questions, but it's really the team that I'm a part of that's tied to the successful results that we're seeing. And really the results this quarter are a function of catching up and absorbing the supply chain disruptions that we've had to navigate around quickly. So I think we're on the right path, and I think we certainly are in a better position today than we were 3-6 months ago, and we'll continue to take on the challenges as they come and try to navigate as adeptly as we can for our shareholders. So thanks for giving us an opportunity to provide an update.
Yeah, well, thanks for running us through the quarter and providing a bit more perspective on the business. Every time we chat, I understand a little bit better. Yeah, no, I appreciate that. If anyone has any other questions, feel free to reach out and I'll get those answered for you. And yeah, congrats on a great start to the year, Pete. Looking forward to seeing Tantalus grow throughout the year and, exciting times.
Thanks, Deb. Appreciate it. We'll see you next quarter.